Starting with the shipper point of view, certainly we've seen a shift in mindset for sure as the year has gone on, to kind of echo what Ken said. But how can you blame them, right? To some degree, every single time we've seen rates increase, there's been a catalyst, right? Whether that was Fern or with Iran driving up oil prices, or even, as we got into the summer peak, right? Seasonal demand, road check week, et cetera, irregular shipping patterns. I mean, once we got past those, though, those disruptions, I think that pattern matters, right? The annual seasonal cycle is really important because I think the rate trends have followed that pretty closely. We're in a vulnerable state right now. And I think we're going to continue to see large scale spot rate swings when we see disruption until we see those contract rates reset and alleviate pressure in the spot market. So to me, the first sign that we're going to see any kind of long-term stability with rates is going to come from declines in the tender rejection rates, right? You need to see contract routing guides reset to the point where you're seeing in mass improved primary tender acceptance. That's going to limit that demand in the spot market that creates the opportunity for these rates to continue to cycle up. So I think it's really important to watch and see what we see from a contract reset perspective in the third and fourth quarter here. I think that is going to be an important catalyst. If we begin to enable and facilitate tender rejections to come down, which is possible, what seasonal disruptions do we see between July 4th and Thanksgiving? It's pretty limited in what's expected every year, maybe a little bit around Labor Day or an end of quarter, but that's a pretty long period of stability we could be entering here, right? And it gives a large opportunity for current rate environment to be considered the new floor for contract pricing. So I do believe that this is a critical point. I still think it comes down to, in terms of the duration here, how long it's going to take to get capacity or supply on the road to help meet that demand, especially if we see demand growth. But we're going to stay inflationary in my mind until we get to the big pop of May of next year, at the very least, just from how much higher rates are now than they were even just 60 days ago. It's going to be hard to be back below negative year over year until we're back to May, June next year at the earliest.